This is Randy Finney with Right Side of the Chart, and today is Friday, January 26, 2024. It's 9:08 a.m. Eastern as I'm starting the video, so market hasn't opened yet, but I'm going to get one out to you. I wanted to record this. I've got somebody coming by the house today for home inspection, new insurance thing. They're getting really nitty-gritty down here in Florida, so that might take a while, and therefore I wanted to do this video before they get here. All right, this is, I mentioned a few days ago that I would do an update on the market breadth, and I've had a couple requests for updates on the semis, so I'm going to try to wrap them both in the same video. There's no point in going over 100 charts, showing you market breadth, but I'll show you a few of my, my favorite indicators. Starting out with this one, this is the NAHL, that's the NASDAQ New Highs versus New Lows Index. I don't know if you can make it out here. What I say is I've used this one for years. While there are a fair number of brief whipsaw signals, bullish and bearish crossovers of the 20-day EMA on the NAHL, the new highs to new low ratio, have been quite useful in early identification of trend changes in the NASDAQ composite. So it is a trend indicator, and it also, as I said, kind of comes pretty early in major trend changes. Now, what you can see here, it's, well, you may not be able to see in the video. If you're looking at a regular monitor, you can. If you're checking it out on your phone, maybe not. I have these red and green lines that I haven't updated. Well, actually, you know what? There's no reason to. The last one we had was right here. Again, the whipsaws, what I did is I put a custom histogram right here. It says MACD, but it's not. You can reverse engineer a MACD to show you any two lines like I've done here. You have the NAHL and its 20-day exponential moving average. And then the histogram, if you plug in these parameters, will show you when the lines cross, maybe bullish and bearish crossovers. And again, so you can see the red and the red and the green lines are the bullish and bearish crossovers, or just look at those histogram, what I call hills. So there was a bull trend, clear bullish trend. There was a clear bearish trend, and you can look above. Oh, I'm sorry, here's the market down here, the NASDAQ composite. That right there was the bear market with near impunity. There was the top right there in October of 07, and there was the end. Officially, the bear market was actually right here. And you can see that's it captured all of that right there. In other words, it told you as a investor or trend trader more so, hey, be short or out of the market. Again, I take it in conjunction with other things as well. It's not a standalone. And as I said in there, there's quite a few whipsaws here and there. But look at this, how well it's defined what I still consider to be. I don't care about new highs in the S&P. Again, the majority of stocks and the equal weighted index, everything else is down. You want to use semantics and say the bear market's over. Say what you want, but this is telling me by this trend indicator, this is still bearish. We've had a couple of whipsaws. Hopefully you can see them here in the video, and they were brief, including one that just happened. So there's one, and right here. But overall, we've been pretty much since that was when the market peaked. The NASDAQ peaked. That's what I'm looking at down below in October. It was October of 2021. The S&P and some other indexes peaked right on the beginning of the year in 2022. And again, it's done a good job. So you can see bull trend, clear bull trend. You want to be long and strong. Bear trend, again, been a heck of a bear market rally. And I will say right now they've crossed. They're in the bullish technical posture. But if you look closely, I can't roll the scroll wheel on my mouse and zoom in. That's a shortcoming of this charting platform. But you can see the lines have rolled over, and you can see the histogram is getting close to crossing back down. So the market goes where I think it will in the next coming weeks, the coming months, then we'll certainly, that will prove to be a whipsaw, just like that one and that one. And when you go back, you can see in a bear trend, you have some whipsaws every now and then. Okay, so that's just one of many. And right now, if you want to just be a purist, chalk it up to bullish, from the last signal. I hadn't been there very long, but if that crosses back down, again, it's just going to keep this trend intact. And it fits with the narrative or the thesis I've had since before the bear market even started, that this would be much, much different from any bear market in recent history, going back a half century more. The bear markets in recent decades have been kind of over before you know it. 2000, late '07 to early '09. That was, whatnot, a year and a half. And that was the worst, one of the worst bear markets in history. I think this one, again, I've used the analogy, look at the Japan Nikkei index and see what it did from about, the 1990, the beginning of the 90s, all the way up really for since then. And I think we're looking at something much similar coming up. So you're going to see big bear market rallies and big, bear market drops. And they will be in themselves, we can call them micro bulls and micro bears, or really cyclical bull and bears within a larger secular bear. Again, that's what I think is the most likely scenario. But again, you can use this if you want to incorporate it into your trend trading. It's not, you want to really hone in on entries and exits on active swing trading using 60-minute charts. I just wanted to point that one out to you. And again, you can replicate that chart. This is from stockcharts.com. And I believe they do have a free version. I just don't know if you can go back this far in time using their free account. Okay, and before I get to the other market breadth indicators, let me just show you a quick overview. This is the S&P. These are weekly charts, and so all the obviously the market cheerleaders are coming out on CNBC and all the other channels and cheering the new highs in the S&P 500. Again, if you inflation just look at real returns, then you're way down because since the market peaked back here, even according to what many believe are grossly understated government numbers on inflation, I still think that's somewhere in the mid to low 20% inflation since then. So you really knock down purchasing power of the dollar, and you're 20% lower. But that's whatever. You're trying to fit narratives, semantics again. But this is what I want to show. RSP is the equal weighted S&P 500, still well off its highs from back then. So this is more of, if you want to say what is the stock market doing, then you want to put an equal weighting. And then you also want to look at things like the mid caps, still MDY, that's the S&P 400 mid cap ETF, and still well off its highs right there. IWM are your small caps. I mean, not even close. They're still 20% below their previous bull market highs. What else you have? Oh, and then of course QQQ, which again is not a balanced index. Far from it's pretty much a tech fund. It mirrors XLK, the tech ETF. Very unweighted, slight marginal new high. Again, it's been my scenario. It was my alternative scenario several months back last quarter, but never ever took it off the table. Said I wouldn't take it off the table unless we took out those key support levels, which we hit, and which time we covered shorts and went long. So it's this is that then. Put this scenario in play, and that's exactly what I still think will happen. You turn on all lines. You've got the big negative divergences right now, similar technical posture. Again, let me get into the charts of the semis in a second. However, take away the top weighting of those what I now call the Mag 5, and you can see that QQQE, the equal weighted, still well below its peak, as is the NASDAQ Composite Index. The QQQ NASDAQ 100 is just the top 100 largest in the NASDAQ. So there it is. I showed you small, mid, large, everything. Again, especially if you strip out it's the mathematical, weighting that those guys have. So again, you take whatever argument you want to make, call it bull, bear. It's really, again, semantics. It's irrelevant. It's how you're going to trade today, tomorrow, next week. Nobody's been long or short, at least not that I know of, throughout this whole thing. This is swing trading. We're trying to capture these swings and get in front, and that's where active traders make their money. Okay, let's go back to the indicators. Let me cue up another one. Okay, another one of my favorites, the NAAD. That's the NASDAQ Advancing versus Declining Issues. So up top, as you can see here, you have the NASDAQ 100. That's what I'm comparing to on this chart versus the NASDAQ Advancing Declining Issues. highly reliable indicator for me. I've learned over the years that this one, it shows better tops. I'd look, there's not many at the bottom of the market. There's not many divergent lows. So that's why you're only seeing the negative divergence lines. It just works better that way as a topping, looking for tops or identifying tops that are coming versus bottoms. There's other things we use for identifying bottoms. But as you can see, this is going all the way back. This is 2003. There was the bear market that ended after the dot-com bubble, just to the left of the chart. Again, this is the NASDAQ up here. And this was a bull market from, in '02 all the way up to the peak in October of '07 right there. And you can see, in early on in a bull market, this is what you'll see. You'll see the NAAD, the advancing versus declining, moving up. And that's a sign of a very healthy market. That's what you want to see. Then once you begin to get divergence, this is your divergence line from here to here. And let me clear those lines out. You can see them all there in blue. Let me just go through them fast. There's your divergence. And this one, it often takes years, if not months. Now remember, in a bull market, and I say this often, stocks drop a lot faster than they rise. That's one reason that I love shorting just as much as I love going long. You just have to be Johnny on the spot with your timing. It's like a bull market and fast forward speed times 2 or 3. This was a 55% drop in the S&P and the NASDAQ 100 back in that last bear market. And so what happens then, if you're in a bear market and you have a bear market rally, you tend to not stretch out years. It's usually the bull markets that divergence is going to build for years. Bear market, it doesn't look like much here because I'm using log scaling. You can see over here, but that again shows you a 55% drop. It also wiped out years, many years of gains were wiped out in just that 15 months or so, whatever that was there, all right? And that's another reason it's so important not to drink the Kool-Aid. Believe me, I used to be in the industry. I used to be on the other side of this as a financial advisor. It's time in the market, not timing the market. Don't be sore, buy more, all that stuff. We're going to have at some point, and I believe it's likely in the future, a bear market that will again make previous bears look like what they were. They were, again, if you held your nose and just, buried your head in the sand in those last two, guess what? You were actually bailed out. Fed bailed you out. It was big drop, but you came back, and then within a few years, you're back to where you were. But again, that may not be the case. You never know. So let me just show you the chart, and you guys figure out what you want to do. There's the divergence right there leading up. That was a double-digit drop. Clearly, this was a year, over a year, almost a year and a half, if you go back from this point where the market went sideways to down. So it's really what you call a deer market, neither a bull nor a bear, and the divergence identified it. So, and there were two drops of roughly 20% in there as well. So that was a very, clear divergent high right there. There was divergence leading up to COVID. That's the Q4 drop. Yeah, that was COVID. I'm sorry. That was COVID. Had the divergence. As I said, COVID, technically speaking, wasn't a random event. It will go down in history as a black swan. But the markets were indicating whether COVID hit or not, we were going to have a bear market. The Fed just is what I labeled it as Ursa Interruptus, a bear market that was interrupted by the most massive central bank intervention in history and fiscal and monetary stimulus. So that gave us, they hit the full triple dose of epi, which is adrenaline, into the markets and gunned it up again to right here. That was the last. Again, it's the track record to me is phenomenal in this indicator. I'm showing you all the divergences, and then that foreshadowed the bear market that we had in the NASDAQ from October 2021 into, was it November? I'm sorry, November 2021 into the October lows right there. And then NASDAQ 100 really took off in January. And here it is. So this is a breadth indicator because you're looking at advanced versus declining issues, and look at that divergence. So it has been the same thing, fewer and fewer stocks, i.e. think Mag 7, now Mag 6, Mag 5, whatever you want to call it, FANG, whatever term you want to use. Nobody can argue. It's been widely written and publicized, and the stats are there. I don't have them in my head, but they've done the majority of the lifting. And again, this is what I'm showing you, that the market breadth is not confirming that we're in a new bull market. Now, look, I need to say this. It is very possible that there is a handoff and maybe the fangs stall out for a while and you see the other thousands of stocks that are still well off their highs start to rally and market breadth improves. And that's something I'll look for. And in 3 to 6 months, I may be changing my tune about, I might say, hey, maybe there is a big bear market coming, but it might be a year or two away. Right now, I don't see that. I see, in fact, dangerously stark divergence, showing, again, narrowing breadth in this market. Okay, here's another one. This is the NAA 200R. That's the NASDAQ percentage of stocks trading above their 200-day moving average. Now, I've had this chart here forever, and I've always had it because it's the NASDAQ composite, the percentage in the NASDAQ. So I have the NASDAQ composite up top. However, as we all know, the NASDAQ 100 has just popped and made a slightly ever so marginal new high. So if I had it up here, it would look almost identical. This would be the same because they don't have an NAA 200R that's only for the NASDAQ 100. So you do have these big, massive divergence. And again, just take a look at this chart. These are all the divergences. You can see them here drawn out. That would foreshadow the 55-ish% bear market back in '08, the Great Recession. You can see the measurements here, at least I can. That was about a 20% drop, a 20% drop, all off these divergent highs. 12.6, 17.5, we'll call it 18%, 25, 30, whatever that one was already. And again, it was all of those, each and every one was foreshadowed. Now you can see the stark divergence here. So the NASDAQ, again, NASDAQ 100, all-time highs. Market cheerleaders are out there with their pom-poms on TV, but yet why are over half of the stocks below their 200-day moving average? That shouldn't be the case when the market's at new highs. And it just shows you, again, it's mathematics, guys. It's not hard to figure out. Most stocks are still in, pretty much in bear market territory down there. You can see it's 47.46. Okay, this one's similar. This is the NAA 50R, so the percentage of stocks trading above their 200-day moving average. 50-day moving average in the NASDAQ. Same. This one I actually happen to have the NDX up top, so there it is. I haven't updated it, but I'll do it right now. There's your divergence line. Prices in the index making higher highs with stark divergences with lower lows, and you can see all these divergences that I have in the past, including that one. It's to the left of the chart. I've been tracking this for years. 54% drop, 20. I already did the drops. And again, same, well, that was on the 200, but you can see it here on the 50s. All these were double-digit drops, including they've captured all the bear markets in the past. This one's big. And so this whole thing, Fed has supersized this bubble, and really the magnitude, I think, of the next bear market when it comes. And even if you want to look at it this way, even if you don't want to take that big divergence line I just used, you can see from this point right here to right there, you can see the number of stocks trading above their 50 is making a lower peak, and it's way down here now, dropping as the NASDAQ 100 is at all-time highs. Okay, so that's it. That's pretty clear. That all under the hood isn't as well as it might seem when you look at those unbalanced overweighted index. And again, the takeaway is that is a signature. I've been doing this a long time. You can look up, read on it. That is a signature of a bull market or a bear market rally top. It's usually the fewer and fewer stocks doing most of the or all of the heavy lifting or most of the heavy lifting. And again, if that starts to change and you start to not have divergence, you start to see all these breadth indicators improve, then you've got a case that, hey, guess what? Maybe we're looking at good times ahead. Not bad. Okay, and there's other breadth indicators out there, but at this point, I'm just beating a dead horse. I think those guys show you pretty clearly what's going on. Let me do this. Let me go to I'm going to do the update on the semis. It's been requested, and I'm going to just go to the semiconductor equipment makers first. So it is. Semis are widely considered the canary in the coal mine, if you will, for the tech sector. And the tech sector is all about the market. And in 2023, for the last couple of decades, tech has increasingly become didn't used to be the largest part of the market, but it most certainly is now. It dwarfs the next largest sector, which is healthcare. Tech is, I think it's over 25% of the S&P 500, and it's over 50% of the NASDAQ 100. So now, and the semis are kind of the canary in the coal mine for the tech sector as a whole. And then within there, you can even dig down deeper, and the chip equipment makers, those that make the equipment that make semiconductors, are the canary in the coal mine for the chip sector. So, things you can watch are the book-to-bill ratio, but I like to watch also the equipment makers. So I'm going to go through those quickly. We had a couple, at least one report last night. I think it was KLAC, 10 core. I'm going through an order of market cap, so keep that in mind that these have a bigger weighting. And I'm just going to tell you this. The story is the same on just about all of these, but you need to see it and then make your own decision. So you can see here a divergent high followed by that, which ended in a divergent low, which was followed by that. You had a beautiful little wedge there and a divergent high, and you had a correction, the double digit, well into the double digits, another divergent high right there. I don't have them all marked, but you can see my divergence lines. That was well into the double-digit drop. And now here we are with a big divergent high and extreme overbought conditions. So the only thing better in my book than negative divergence when you're looking to short something is negative divergence with overbought, and even better to see this was overbought right here. Overbought. You can see the red line. There's your 70 level overbought. Then I have a purple line. I do that to all securities. I look at the chart and say, okay, we all know 70 is typically on most things overbought. Well, what is the extreme on this particular stock or sector? And on ASML, it's about 80. It says 79, 75 right there. That's what I call the extreme overbought. That tends to cap the advantages, and that's where the bigger tops come from. When you get that extreme overbought, remember this one and this one came with overbought and negative divergence. This one came with extreme overbought and negative divergence, just like we now have here. You also have the makings of what I believe strongly to be, or most likely, only time will tell, a blow off top. Look at selling climax, blow off top, same thing. You see the volume bars here, that big surge. Huge spike up in volume. It started right about here. I believe you can see these bars starting at this point. That is extremely indicative to me of a blow off top, i.e. buying climax. You got a doji candle there. And again, I'm just telling you right now, if you want to handpick semis, I like these equipment makers. I'm going through the charts now, and they're all singing the same song to me. The charts are nearly identical. And again, do the math on, similar technical postures. I get the comments. I know nobody wants to short the semis right now. It's been a tough, I've been trying to call the top on these guys for a while. Called it back there, last year, nailed it down. And then, we hit a lot of the key semis, hit some of the downside targets I had, some of not the final targets, but my third out of 4 or 5 targets. And that's where you can see we had positive divergence. There was every reason to be, long there and not continuing to short. Look at that beautiful support level AMAT hit. But now we've come full circle. Divergent high, AMAT's a big one. Divergent high there. So again, it's not, that could have marked the top, but it didn't. What happened is we thrust it up, made a marginal new high, just like the NASDAQ 100, and the divergence is now not only not negated, meaning not taken out, it's even larger, much larger now, indicating a much larger drop. We need to obviously take out that trend line, but that gives us a big wedge. And you can see some of these guys even put in bearish engulfing candles yesterday. So here, I put a little line here. I'll just say, based on the technical posture and where we're at, I know yesterday I was saying, on NASDAQ 100, and it's true, there were no sell signals. There was that active trading thing where I said you're going to get the mean reversion, and we got it with the markets ignoring the fact that euro was down and stocks thought they could rally. And then somebody, right after I put that post out, handed them the memo. Hey, guys, take a look. Euro's going down. You guys can't be going up. And they, NASDAQ put a hard reversal in over, 1.25% or something. But there it is. Again, the technicals are indicating a substantial drop. I did in December a very in-depth video from a longer term perspective. I'm not doing that here. I'm not on the weekly charts. You can see that one if you want to know my longer term targets. LRCX, Lam Research, big divergence. Again, very indicative of a blow off top here. KLAC, same thing. All this recent price action, this near vertical move, many of those on increased volume with the divergences that have been building, tell me that looking at probably a significant top here in the semis. ENTG, Integris, you can see just how the charts go. This was actually a big divergent top there, divergent high. Divergence have been building, and we were getting corrections off the initial divergences, double-digit drops, and then we finally got the big one here that culminated with the big divergence, just like we have on the indexes now. That was a 61% drop in this stock. Even right here, in this bull run, we put in a divergent low. A lot of the semis did there, but in that little divergent high right there was good for a 26% drop. So maybe you believe in the semis long term, but you're also a flexible trader. You're not married to any one thing. You can, these are good for, even if you believe there's a longer term uptrend intact, there's an uptrend line to watch. If that breaks, it's going to call that into question, but it would also be a nice target to swing it down to right there. And that would be about a 20% drop off this divergent high. And again, there's not a lot of really some of these might have some sell signals. I didn't dig down deep into the charts there. So it's more of kind of, hey, these charts just look ripe to roll over any day or any minute now. But if you want to play it safe, like here's TER, Teradyne, and nice clean uptrend line, bearish rising wedge pattern, divergent highs. So you wait for a break of that. And these are old levels here. I haven't updated a lot of these charts in a while. Just to mark up some of the divergences, but it's the same story. I'm clicking on again on the watch list, all the components of the semiconductor equipment list, and same thing, wash, rinse, repeat. Divergent high, drop, divergent low, rally, divergent high, drop, divergent low, rally, divergent high, drop, or maybe it goes up, makes continues to diverge, and then I might be looking at this next month, talking about the same thing unless these divergences get taken out. All right, so from here on out, I don't have them all marked up. You can see as I go down the list, some of these are the smaller ones that are already well off their highs. And those that are at new highs, it's the same story. I don't see any that are at 52-week or all-time highs that don't have divergence as I go through this list. I'll be honest, I haven't gone through them all. I've just gone through the top dozen, and when I started out at ASML, it was a $333 billion market cap. Now I'm on the number 12, and it's only $3.5 billion. So the rest of them aren't going to move the needle if I keep going down the list. It's really, you want to get an idea on how the leaders in the sector are doing. But I mean, there's just a lot of beautiful looking shorts here. And again, a lot of them are still above trend without any strong sell signals, but sometimes you can go down like this, see a little short-term trend line there. You go down to the 60-minute chart and see if you can draw a clean trend line, or if you can identify any, horizontal support levels. And, I will say there's something to be said about, being, playing it safe, give it the benefit of the doubt. That whole second mouse gets the cheese thing, that's certainly, been in play lately. So that would be, there's your trend line. That's how I draw it, coming off the May lows right there. So you set a little price alert if you're interested. Just remember, when I go down the list here and you get to the smaller market caps, there's less volume in those stocks, and therefore your broker may hit you with a higher borrowing fee on some of those. That's why you want to tend to short the most liquid, actively traded stocks if you are a short seller, or you just keep it simple, and that's what we'll segue into and then wrap the video up. SOX, SOXX, or XSD, any of the semiconductor ETFs. Remember, SOX is very heavy in NVIDIA and a couple of it's not as well balanced as other ones. This is a very balanced. I've looked at it before and dug into the holdings. And so it's more like trading the equal weighted NASDAQ, if you will, versus the NASDAQ 100. And again, it's telling me the same thing, that semis peaked back here. And they are still well below their high. And that is, again, if you take them collectively, there's 39 semiconductor stocks I'm showing in this ETF here, XSD. And again, it's a well-diversified one. Put in a divergent high. So far that it has been the high. It broke down from this beautiful little bearish rising wedge pattern right here. Break down, hit support, bounce, but it's so far reversing. It's just been a snapback rally. So this one is on a sell signal as a sector right here, and we'll probably continue down lower. And the other one was SMH. And SMH, again, just happens to have NVIDIA in there, a lot of NVIDIA. It's split at some point. That's why all these lines are quirky. But I can just show you it's got the divergence. And let's just go to SOXX, because that's the one I usually cover in these videos. And for those of you like trading the juice, be careful with that. I'm talking about leverage ETFs. This is the one that SOXS and XOXL, I believe they're both 3-time long and short. They track the same sector, I believe. There it is, rising wedge. Look at that big reversal candle yesterday down there. Big negative divergences, just like you had back there. You know, you go to the weekly chart, turn on all lines, you can see it here. This is the divergence that we've been building right here in the shorter term. So you have really divergence. You look at this weekly chart back here. This is how I look at things when I go to my weekly charts. I see the bigger picture. And there's your primary bull market uptrend line. These were just bull market corrections that all brought us back to the trend line. This one here, 42%. And there's the video. That's the one I'm referring to when I did the longer term outlook. And this is where I think at least we're going down here and most likely here. That's T2 target I laid out back here. And so this is just pretty much an overdone, most likely bear market rally. So those are your longer term targets. Now let's rifle through the components. So you have, remember, this one's less diversified. There's 24 stocks. Here's NVIDIA, bulletproof. Made a comment in the comment section yesterday under the post. This post here, stock market neurodivergence unlikely to continue. And it didn't continue after that. We had the QQQ down. And so, you know, somebody didn't like this. Somebody mentioned that they were, you know, talking about pets.com. And if you weren't around or weren't trading back in 1998, 1999 really is when everything went crazy. Pets.com is considered the poster child of the .com bubble. And I was most certainly around. And so my reply there is .com circa 1999 equals AI 2023. And let me be clear, because I think 2024 will be a lot like 2000. 2000, again, if you were trading back then, you remember the NASDAQ peaked in March of 2000 and then fell almost 80%. I think it was a 78% drop on the NASDAQ composite. And then I said history doesn't always repeat, but it often rhymes. I've shared this chart before. Given what I did here is I put on arithmetic scaling, but this is the bull market leading up into the 1999. That's where we just hit the turbo boost, turbocharger. Then we had a big drop, initial wave down, a bear market rally. And then that was the, like I said, I think it was 78% from high to low until the market bottomed in 2000. So the bigger the bubble, the bigger the drop. And this, I zoomed in. This is a zoom in, 1999, right? Starts right here. That's where we started shooting up. Initial drop, bear market rally, and this is today right here. I mean, it looks so similar. It looks so similar, you almost think it can't possibly work out the same. Maybe not. Like I said, history doesn't always repeat, but it often rhymes. And there's your initial drop. That was into the October lows in 2022. And again, this is a NASDAQ composite. As I said, everything out there in the NASDAQ, not just what the Mag 7 are doing. And we have not made a new high, so I'm maintaining it's likely a bear market rally. And because of the look of the charts, this parabolic advance, they don't end well. Look at orange juice. Remember we shorted OJ with a parabolic advance. I covered that a couple of weeks ago, but it did just that. It had one like this, it was a kickback rally, and then a huge, strong drop. They are some of the most profitable short trades, and you don't get them on the reverse. You don't usually go parabolic into a low. Sometimes you can, but anyway, so that's where we're at. And to me, again, this chart speaks volumes, and everything's there with its sentiment. This is if you traded enough cycles over the years, bull and bear markets, that the masses, and you almost have to. I talked about that, how you have to be convinced that the worst is over to get to that first initial, bear market rally before the big drop. Oh, you know what I didn't do for you? Oh, I got to go back. Good. It's the last breadth chart I was on. So you remember, if you don't, in the last couple of videos I showed you in the VIX and some other indicators where previous bear markets have ended. I'll get to that in 1 second. And I had it here too on the NAA 50R, and I think I have it also on the 200R. This is again the NASDAQ percent of stocks above their 50-day moving average. That's where the NASDAQ 100 and the NASDAQ bottom. Most don't know it, but it was October or November of 09, right there, November of 09. And everything else, the S&P, the small caps, they all bottom in March of 2000. But you can see that's where the NASDAQ bear market ended, technically speaking. Again, everything else followed. And this is where COVID ended. Okay, so I have so many very reliable indicators that tell me the drop that ended in October 22 was not the end of a bear market, rather the end of an initial bear market rally, because several of these very reliable key indicators, they didn't hit those levels that mark the end of a bear market. So keep that in mind. Where that's where we got close, but so we got close there, and we got close there, and we got close there, but those weren't bear markets. They were just corrections in an ongoing bull. Okay, all right, video's getting long enough, and I got to go. I've got somebody coming soon. Just going through some of these charts. Broadcom, bearish engulfing candle yesterday. Look at that, nice. And let me give you some trading tips. Okay, not just analyzing the charts. You decide what you want to do. You do you, I do me, as far as positioning goes. But one of my favorite trading setups is this, bearish engulfing candles, as well as island tops, because you have excellent RR. In other words, a bearish engulfing candle, you want to look for at the end of a very extended, an overextended run, end of a bull run, just like you look for a bullish engulfing candle at the bottom. Now look closely here, and you will see that's exactly what Broadcom, the S&P, a lot of things had. This is a textbook bullish engulfing candle. I highlighted back then on the indexes. We had on so many stocks. And the reason these things, I love trading them, because again, the RR is phenomenal, because what you do is you basically, if you go long on a bullish engulfing, you put a stop below the bottom of it, because the next day, by definition, it has to engulf the previous body of the previous candle. In this case, it engulfed the previous two. And then from there, you can't go down, because by definition, it's no longer a bottom, even if you slightly undercut it. I mean, it doesn't mean that won't be the bottom, but from my experience, you usually don't. So what you do is you see it that day when you have a big reversal and you see, okay, I got a bullish engulfing. Before the market closed, you go long, and then you put a stop below previous day's lows. So in that case, you would have had a stop that was 5%, roughly a little below 5% below your entry price. Again, assuming you bought the close, you might have got in better. And then, boom, you had all that, and still going. Again, I'm not saying you would have rode the whole thing. Maybe you would have 200% return on your money. And now you have a bearish engulfing candle. So again, the strategy is the same. You could have shorted yesterday at the close. You could short right now if you want. And then you have the high, the top. Remember, it's the body of that candle. So that one engulfed that one. So now you put a stop above yesterday's high. And even right now, that still gives you a downside of about 5, a little north of 5%. And it is, again, most important, you have to remember, or I would suggest keeping in mind that if you're right and it's a top, a bearish engulfing candle, sometimes you just get corrections out of them. Sometimes they just happen and the things power on up. But if it does prove to mark a top, then me personally, I'd be looking at, probably better than at least I would say, just let me turn on my lines here and give you an idea. I mean, even for a correction, we're probably going to come back. Here, you can see I already color-coded this one up. I have a purple trend line there, a very key uptrend line. That would be a minimum target. And so right now you short it here. That's going to give you about a 15% drop. There's also that reaction low right there. So, oops, that's not the one I wanted. Get rid of that. I need to put a line right there. There it is. There's your first target, about 1,042 plus the uptrend line. That goes in 924, and if that goes 820, and there's the purple lines that I had way back when I said until those purple lines go, I can't make a case to be aggressively short, especially for a long-term position, a long-term trend position. So let me just go through the rest of these. I got to get out of here and get the video out to you guys. Little doji right there, reversal. That's a nice little reversal pattern there. Same thing, so short that one, stop above that recent highs. Big old gap to be backfilled. Minimum target down here would be a test of the breakout above 766. That'd be a 10% drop. And then if that goes, that's no bueno, because then you have a false breakout, a failed breakout. So let's see something like this. Boom, boom. And again, you could cover there. Look at it collectively. What's everything else doing? What's the sector doing? What's the NASDAQ doing? And then decide whether you want to cover or just, tuck it away. And you can, in other words, in trading, you can try to hit a lot of singles, and doubles, or you can, be a slugger and go for the grand slams and the home runs. And in this case, that's where you go back to that December video that I covered and gave you longer term targets on all these guys here. There's an example, T2. This was laid out back here. I imagine there's very few people out there in the world that would have called these stocks down from in 2021 at their highs. And it's similar. This was a stronger bull run back then. And there was the trend line break in the back test. These were the targets I laid out. And you can see in February of February, only update when it was hit, change of color, February 3rd, 2022, calling for a move down to there. And then the trend line, we hit that trend line perfectly. And that's where you would have covered that short. You would have made, if you shorted this thing down and you were going for the grand slam or the home run, you made 60% on your money. And then you could have covered in reverse and gone long and turned that into, many times that. And so now we've come full circle, virtually identical technical posture. And as I just said, on the daily chart, you have an objective entry. And look, worst case scenario, maybe this tech thing keeps going, the semi thing. I know under the CHIP Acts, I know there's still a lot of money that hasn't been deployed. I've read about that, blah, blah, blah. And again, you want to trade off fundamentals, good luck. You want to incorporate technicals. Of the two, technicals is going to be much more accurate, especially for swing trading, but as well for investing. And the best is when technicals and fundamentals line up. But again, the upside is limited, or the downside, if you have a stop above the recent highs, would be limited. Now, you may want to give it a little more room. Maybe the powers that be know if they can pop that, they're going to pop a lot of stops on short sellers. So you might want to put your stop a little bit more out of their reach, again, if you are going for the deeper targets. But if you're just going for that quick pullback trade to the minimum target down there, 11% or so, then yeah, you do want to keep stops tighter. All right, guys, we can go over and over and over all these. AMD, you can see these purple boxes here. They, to me, well, they were buying climaxes. See that vertical lift and then a big correction. Near vertical ramp, correction. So maybe the uptrend continues up, but at very least, I think the case, and here's your uptrend line you need to take out. But again, you have big divergence this time around. These other ones where you had these little buying climaxes, you didn't have such big divergence. Back here, that big divergence ultimately resulted in a drop of about right there, it's 67%. You can see my pop-up box. And so we have nearly, not as big, but nearly as big of divergence. And, if you're going to trade off that divergent high, and based on where I think this thing's going, whether it comes here now or not, probably at minimum to this trend line. Well, I'm sorry, minimum right here, 133. That was the breakout point. That's a 28% drop. And yeah, you're probably going to have one more reaction here at this uptrend line before that. Intel, divergent high into resistance, breakdown of a beautiful little bearish rising wedge right there, breakdown, little snapback rally. Earnings took it back down to this key level. That was support. It is support, 43.54, with the next support there, 40.55. Then you have this uptrend line off the lows. So that's the likely path for Intel. Qualcomm, divergent high, big divergent high. All right, I could go on and on. Texas Instrument, divergent high. So divergent high and AMAT, I already covered AMAT. Lam Research, I already covered. Analog Devices, big divergence. I'm going to stop it here because I got to go. I can go through the rest of the semis. You're going to see almost all the same things. Any of those that are at or near new highs have big divergence in place. And I wish there was a better sell signal overall on the sector right now. This is, again, SOX, but I covered, almost a bearish engulfing on SOX. But remember, SOX is not the only one out there. This is XSD. So that one you can make a case to be short. And then SMH. Oh, and remember, when you see if a major turn is coming in the semis, just bear with me. Just go with that for a second. Then the hype, that AI hype for NVIDIA, you're going to have more bang for your buck, I believe, in stocks, those that are top heavy, NVIDIA and some of the other ones that have been the biggest beneficiaries of this AI hype. Because when that trade goes the other way, typically those that come up the most, the further you go up, the harder, the more downside you have to fall, generally speaking, because birds of a feather flock together. And if you don't understand how it can work fundamentally, because if you believe so much in this AI hype, it's going to just keep these stocks on this parabolic moonshot advance forever. Just know this, that it's simply fund flows. When the sentiment shifts and people start booking profits on the semis and institutions and individuals, and then money is coming out of these ETFs, those stocks and the tech sector as a whole, those stocks are going to get sold proportionately. And right now, NVIDIA has by far the highest proportion. Most of the money in these semi-ETFs is in NVIDIA, and same thing in QQQ. So then when those flows go the other way, NVIDIA tends to fall just as hard as it came up. So, all right, guys, I'm going to wrap it up here. I got to run, and I'll see about maybe I'll get something else out to you later today. I got to get wrapped up here. This has been Randy Finney with Right Side of the Chart. Have a great day.